Welcome back to Personal Pension Radio, episode 266. So excited that you're joining me once again. Please, if you're listening to this on Google Play, if you're listening on Spotify, iTunes, wherever you might be getting this podcast, please, I am on the hunt for some more five-star reviews. Five-star reviews really help the algorithm in podcast land. iTunes especially has been pushing those five-star reviews. So please, take a moment. Hit me a five-star review if you would. If you're watching on YouTube, hit that like button, subscribe, and hit the bell icon. Love it. Let's get into this. I want to talk to you on this Watch Your Step segment about some of the economics of retirement income. That's a very important phrase to pay attention to. The economics of retirement income, because the economics of retirement accumulation, saving or investing for retirement, are very different than the economics of income. Income, of course, taking distributions from the money that you've accumulated. Let's just talk about a few of these things just to consider. Again, there's so much in this conversation that if you want to get into the retirement income conversation, that's where we should actually talk directly and go through your situation. But let's talk about the first thing. There are three functions of money. Liquidity is the first one. Money to provide liquidity. That as you get ready for retirement, it's important to look at money that has been set aside for liquidity. Now, some would say, well, you're not earning a rate of return and yada, yada, yada. It's critical, though, to have money that is, as some call it, dry powder. Dry powder for emergencies and opportunities. That money that is liquid and easily accessible. Keeping that powder dry so that you're ready to get through an emergency or take advantage of an opportunity. So number one, three functions of money, starting with liquidity, just having it ready. Number two is income. Retirement income in this case. The more efficient that you can be satisfying that desired income stream, the more money that you will have left over for liquidity and legacy, which is the third piece. The third function of money is legacy, because you can't take it with you, right? We all hear that phrase for years, you can't take it with you. You've got to look at, for example, which financial product, which financial tool is designed to leave money behind when you die. Now, can you leave real estate? Yes. Can you leave stocks, bonds, investments, etc.? Yes, of course. Was there a financial product that could be used specifically to leave money behind when you die? And yes, this is where you might consider things like life insurance, permanent life insurance, those types of things, right? I often say this to clients that if they really have a desire to leave a legacy, why not let permanent life insurance take care of leaving whatever dollar amount that they want to leave behind? I spoke about this on a recent episode where a client wanted to leave her daughter, her only beneficiary, a specific amount of money. And she set up a permanent life insurance policy that ultimately will pay out a tremendous rate of return on an income tax-free basis to her daughter. She loved it. There was no investment in the world I could help her with that would do what the life insurance did. So as you think about the three functions of money, liquidity first, retirement income second, legacy, because you can't take it with you. So where is it going? What financial products do you have in your overall plan? And what legacy do they have with them? Now, let's talk about another idea. This idea of creating maximum income. Again, the economics of retirement income and the goal of retirement, in my opinion, should be maximum retirement income. Whatever your maximum is different than my maximum. Everybody's going to have a different number. The real goal, in my opinion, should be maximum. Whatever maximum lifestyle is for you, if you look at achieving that number, you've got to ask, well, what financial products, what combination of financial products allow you to hit maximum retirement income? And I'll say this, that a singular product whether it's a Wall Street investment, stocks, whether it's crypto, whether it's life insurance, whether it's real estate, annuities, IRAs, Roths, 401ks, whatever it is, none of those things by themselves will help you hit that maximum income target. You really do have to have a balance. And I would submit to you that a balance of investment and interest rate and rate of return type assets, in addition to actuarial based assets, things like life insurance and guaranteed annuities, that if you have a balance of those things that are based on actuarial science that can complement rate of return and interest rate and dividend and market return type assets, that kind of a combination starts getting really close to the maximum income scenario for most people. So please don't miss that if you only have interest rate and dividend focused and risk related retirement assets with no actuarial based conversation, you may not be getting to your maximum income potential. Let's make sure we talk about that as well. That is a great question to ask your advisor. If you're interested, feel free, send me an email. Happy to chat. Craig with a K at craigstrom.com. Now, last, I want to cover this idea of the growth cycle. Oh, you've got to hear this. Let's wrap up with the growth cycle. Don't stop and start your growth cycle. If you have investments, if you have 401k, if you've got a stock market based portfolio, whatever it is, the best thing that you can possibly do in most cases is let that investment continue to accumulate, continue to compound. In the time value of money equation, the most important part of the equation is time. That if you stop the compounding cycle, you reset the time clock. So if you pull money out to pay for college for a son or daughter, if you pull money out to pay off this or do that or buy this or buy a boat. Oh, I talked to somebody recently who had pulled money out to buy a vacation home. They pulled it out of their 401k assets. They basically reset the compounding clock on their investments. So if you can, avoid stopping and starting the compounding cycle, the most important part of the compound interest equation. If you have not had a detailed conversation with your advisor about the economics of retirement income, I encourage you to do so straight away. Ask your advisor to run your projected income scenarios. If your advisor comes back with a Monte Carlo simulation, and if they speak of the 4% rule or 5% rule or 3.5% rule, and they never speak of actuarial science and they never speak of a balanced approach to retirement income, you might want to get another opinion. I'm happy to help, folks. I am the income engineer. I love this conversation, so please feel free, reach out. Don't forget, smash the like button in YouTube, subscribe, hit the bell icon, and please go leave a 5-star review on the Google Play Store, Spotify, or iTunes especially. Love it, folks. Thank you so much for supporting the show. Take care. Talk to you soon.